Part 12b, Cash Flow Statement, the Indirect Route. Last video we talked about cash inflows and cash outflows, and how the difference between inflows and outflows is what we call net cash flow. We also discussed how without cash, a company is unable to do much of anything. That cash is really the lifeblood of the organization. We talked about how the income statement, the retained earnings statement, and the balance sheet don't really provide us with the information we want to know about cash. The balance sheet minimally tells us how much cash went up or down, but it doesn't tell us why. The income statement and retained earnings statement are focused on income measures, which are not cash. So, we know that to build a cash flow statement, we have to put together 4 sections. The last video, video 4, looked at the operating section, the construction of the first section of the cash flow statement. In this video, we're going to look at the last 3 parts: the investing, financing, and then the cash reconciliation. So, the investing section. Steps to preparing the investing section. Number 1, identify whether the company purchased or sold any long-term assets or investments. Number 2, determine whether these purchases or sales resulted in any cash inflows or cash outflows. 3, compute the net cash flows for the company. So, the investing section. We have to look at whether a company purchased or sold any long-term assets. So for our example here, we're going to say that the company, Carl's Canoes, sold equipment for $4,000 cash and purchased new equipment for $106,000 cash. Now, what does that look like? Well, in the previous video, we looked at the sale of the equipment because it resulted in the loss that we had to remove from the operating section. But as far as the cash flow goes, this first journal entry, the cash flow came in of $4,000, and if we bought new equipment for $106,000, there'd be a cash outflow. As far as investments go, investments are when we purchase or sell other companies' stocks or bonds or things that we have purchased as an investment mechanism. And so if we sold investments for $62,000 cash and purchased new investments for $56,000 cash, we have these 2 entries. Cash was received, $62,000 debit. We got rid of the investments we purchased for $32,000, and we had a gain on the sale of $30,000, which, again, we had to remove when we put together the operating section. The investments we purchased for $56,000 would be recorded as in the last journal entry. So, what do we do with these? Well, the first thing is to identify those purchases or sales that took place. The second part is to determine what came in and what went out. So, as far as inflows go, we received cash from selling the equipment, and we received cash from selling the investments. As far as outflows go, we paid cash for the equipment, and we paid cash for investments. The difference between what came in and what went out is our net cash flow. Net cash flow from investing activities here in this example is $96,000 negative. So, the second section to our cash flow statement is put together very much like what we just walked through. The cash flows from investing activities section will list the cash we received and the cash we paid for long-term investment purchases or sales. And so, the $96,000 negative net cash flow means that the company spent more cash than it received in cash relating to investing activities. Is this a bad thing? Well, not necessarily. As long as the company's overall cash position is in good shape, it is a good thing to invest in new equipment and take advantage of other opportunities. It's not preferable, however, to see negative net cash flow numbers in the operating section up above. because that means that in our operations we spend more money than we bring in. And in most cases, that doesn't speak well to the expectations for the future of the company. So, we had a positive net cash flow from operating activities of $94,000 and a negative net cash flow from investing activities of $96,000. The financing section is put together much like the investing section, except here we have to identify activities whereby the company acquired or repaid capital. Then we're going to determine the cash inflows or outflows and compute the net cash flow. So long-term debt. The company repaid $70,000 on a long-term note and borrowed an additional $58,000 by issuing long-term notes. So we would have two transactions during the year that relate to this. Notes payable go up 70, cash goes down 70. Okay? Or notes payable go down 70, cash goes down 70 to pay off the loan we had before. When we borrow additional money, cash comes in, we debit cash for 58, and we credit notes payable to show the increase in the amount we owe other people of 58. In regard to stockholders' equity, the other place where we can acquire capital, let's say that we sold 2,800 additional shares of stock that has a par value of $1 for $10 per share. The company paid $10,000 in common stock dividends also. What do those journal entries look like? If we sell shares of stock for an amount above par, cash comes in, 28, common stock gets credited for the par value of 2,800, and then the additional paid in capital, the amount above the par value, is 25.2. When we pay dividends, we credit cash and we'll debit dividends payable, the amount we owe based on our declaration, as we talked about in previous videos. So, what are the inflows and outflows related to our financing activities? Inflows, cash received from the sale of stock, 2,800. Cash received from notes, 58,000. Outflows, cash repaid on notes, 70. Cash paid for dividends, 10,000. So our inflows and our outflows. The difference, again, is net cash flow. Net cash flow from investing activities, or financing activities should be, typo there, should be $6,000. So, when we look to build this last section of the cash flow statement, that's how we put it together, much like the previous one. Cash flows from financing activities, cash paid for dividends, cash received from borrowing, cash received from issuance of stock, cash paid on long-term note. The difference between our inflows and our outflows is $6,000. The $6,000 net cash flow means that the company received more cash than it paid in cash related to financing activities. Is a positive cash flow required here? No, not necessarily. As long as the company has sufficient cash flow from operations, the cash flows from financing can either be positive or negative and can be acceptable. The subtotal signifies the end of the three sections. So, the first section, operating section, probably the most complicated to put together. The investing section and the financing section are put together much in the same way, showing what cash came in or was received and what cash went out or was paid. But we still have some work to do. Those first three sections are the main components of the cash flow statement. But we need to make sure that we've identified the right cash flows. And so we need to put together the last part, what I'm basically calling a cash reconciliation. If we have done everything correctly, we should be able to prove that the cash in cash noted on the balance sheet, or that the change in cash noted on the balance sheet, is the change in cash we have identified on the cash flow statement. So the balance sheet shows cash going from $26,000 to $30,000. That's a $4,000 increase. Cash increased or decreased. Is the cash increase or decrease we identify through building the first three sections of the cash flow statement going to match that? That was a confusing sentence. I shouldn't have wrote it that way. Anyway, moving forward. We need to make sure that the $4,000 increase on the balance sheet matches the increase we know on the cash flow statement. And so here we have the three sections. We have a positive cash flow, net cash flow of operating, $94,000. We have a negative net cash flow from investing of $96,000, and we have a positive net cash flow from financing of $6,000. And so if we add those three net cash flows together, we find that overall cash increased by $4,000. Now, we can reconcile that to the balance sheet simply by taking that increase or decrease in cash we put here at the bottom and adding it to what we started with in cash, the beginning cash balance. That tells me the ending cash balance should be $30,000. That number, that very last number, should equal the ending cash balance on my balance sheet, which it does. So this is our completed cash flow statement. The first section is operating, the second is investing, and the third is financing, with a little bit of a reconciliation at the bottom. Now, I want to take a look at an actual cash flow statement, just so you can see that this is really what they look like. So, Starbucks. Starbucks is a public corporation. It's traded on the NASDAQ stock market under the trading name SBUX, S-B-U-X. It has common stock on the NASDAQ that has a 0.001 par value per share. It is authorized to issue 2.4 billion shares, and issued and outstanding at the end of 2017-2018 were 1.4 billion and 1.3 billion shares, approximately. So there's a ton of shares of Starbucks out there. Now, Starbucks, just in case you didn't know, back to my mythology stuff, Starbucks is actually the first mate. Starbuck was the first mate on the Pequod, Captain Ahab's ship in the book Moby Dick. And that's where the name was taken from by the people who started the company. So, Starbucks, over the last 3 years, 2016, 17, 18, had net cash flows from the three activities that looked like this. As you'll see, the operating activity net cash flow went from 4.6 to 4.2 to $11.9 billion. The investing activities went from 2.2 billion to 850 million to 2.3 billion dollars negative net cash flows. And financing went from 1.8 billion to 3 billion to 3.2 billion negative net cash flows. And then you can see the overall increase or decrease in Starbucks cash from one year to the next. Cash went up 599 million in 2016, 334 million in 2017, and 6.3 billion in 2018. So if you will, venture with me here. We're going to go out to Google and we're going to look up Starbucks. Now, I've shown a couple different ways to get to financial statements. You can Google Edgar, and you can go to the SEC website, search for company filings, search for company name or ticker symbol, put in the SBUX that we just looked at, and you've got Starbucks Corporation. But a lot of times, if you're interested in just going through the company's website, you can. But when you land on a company's website like Starbucks or Target or Walmart, this is the consumer-facing website. This is a shopping website. We don't really want that. That's not where we're going to find the information that we want. So if we scroll all the way down to the bottom of pretty much any website, you can find a link for what is called investor relations. And that is where you're typically going to find the financial business stuff, the corporate side of Starbucks. And so here we have their recent announcements, upcoming events, and some stuff like that. I'm going to go to financial data. And under financial data, you can see you can get annual reports, quarterly reports, SEC filings, etc. I'm going to click on annual reports. Here we have a list of the annual reports, past annual reports. Okay. You can click on quarterly results and look at that. The SEC filings, 2018, annual. Here's the annual report for 2018. I'm going to look at it as a PDF. Here we have Starbucks Corporation. Starbucks Corporation, annual report pursuant to Section 13 of the Securities Exchange Act of 1934. Starbucks is incorporated in the state of Washington. Okay. Has its office here, main headquarters, Utah Avenue, etc. Tells you what kind of stock it has, what the par value is, and where it's traded. Okay. But I'm pretty much interested in the cash flow statement. So I scroll down here to the table of contents, find item 8, and it brings me to the statements. This is the income statement. Here's the comprehensive income statement, which we're not covering in the introductory videos. Consolidated balance sheet, and the cash flow statement. So the first section that's looked at is operating activity, and the first thing they list is the net earnings or net income. Then they tell us they're going to make adjustments to reconcile net earnings to net cash. The first adjustment they make is depreciation and amortization. Then they remove some gains. And so they're following the same outline that we just did in the video. Finally, they're looking at the changes in the assets and liabilities. Okay. And they tell us the net cash provided by operating activities is $11.9 billion. The second section is the investing section. Purchasing investments, selling investments, additions to PP&E, so buying those things. And then the financing section is the third section. Okay, where they show us about issuing debt, paying dividends, repurchasing common stock, etc. Finally, we have the net increase in cash and cash equivalents. How much did it go up or down? The cash at the beginning of the period and the cash at the end of the period. So this number, $8,756.3 million, should match what is on my balance sheet up here above. $8,756.3 million. So what we just went through, the cash flow statement that we're trying to learn how to put together, is the type of cash flow statement that companies really use. Now, there are things in this cash flow statement for Starbucks that we won't understand after these introductory videos, but that's why we have more videos to come. So, back to our presentation. In summary, cash flow again is important for businesses. It determines whether a company can pay its bills or invest in expansion. The cash flow statement provides financial statement users with details related to the company's cash inflows and outflows for the period. And we put it together in those three sections, the operating, investing, and financing sections. So finally, this last video of our introductory series, I hope you remember